Money. Here's the strange truth. Money isn't real. It's a shared belief system. A dollar bill only works because everyone agrees it does. There's no intrinsic difference between cash, digital numbers, or even crypto. Only trust. Governments issue money. Central banks regulate it. People exchange it for goods and services. Print too much, and inflation destroys its value. Print too little, and the economy suffocates. Money works because we collectively believe it works. Banks. Now let's talk about banks. You walk in, hand over your cash, the teller smiles, and you leave thinking your money's locked away in a vault guarded by lasers and a dragon. That's not what's happening. Your money's gone the moment you deposit it. Banks aren't giant safes. They're financial middlemen, matchmakers. You give them money, and they lend most of it to someone else, maybe someone buying a jet ski or starting a business. This system is called fractional reserve banking. Banks only keep a fraction of deposits on hand because they assume not everyone will demand their money at the same time, until they do. That's what happened during financial crises when people rushed to withdraw everything at once and the system cracked. So how do banks make money? Simple. They lend your money at higher interest than they pay you. You supply the cash, borrowers create demand, the spread is profit. Banks convince you to play along because it's convenient. Digital payments beat carrying cash. They pay you interest for parking your money there, and it's safer. In the U.S., deposits are insured up to $250,000 per person. Even if a bank collapses, the government steps in. Your shoebox under the bed doesn't offer that. Interest. Now for interest, the silent puppet master. Borrow $1,000, pay back $1,280. Why? Interest. Interest is rent charged on money. If you borrow, it's the fee for using someone else's cash. If you lend or save, it's your reward for patience. There are two main types. Simple interest is straightforward. Pay a flat extra amount. Compound interest is where things get wild. Compound interest means your interest earns interest. Miss a credit card payment, and suddenly yesterday's debt is breeding. That $12 burrito, it evolves into a $50 financial regret. But flip the script. Invest money at 7% annually compounded. Your cash starts multiplying quietly, slowly at first, then aggressively. One day you look up and realize time did most of the work. That's why interest is dangerous and powerful. In debt, it turns small mistakes into disasters. In investing, it turns patience into wealth. The rule is simple. If you're paying interest, eliminate it fast. If you're earning interest, let it compound in peace. Interest will either drain you or work for you for free. Inflation. Ever open a bag of chips and wonder where half of it went? Then you notice the price is 30% higher than last year. That's inflation. Inflation is money slowly losing purchasing power. Your cash still looks the same, but it buys less gas, less food, less everything. Why does it happen? Sometimes people just have too much money chasing the same goods. If demand explodes and supply doesn't, prices rise. Other times, supply chains break, making products more expensive to produce. Businesses pass that cost on to you. And sometimes inflation feeds itself. If people expect prices to rise, they spend faster, pushing prices up even more. A little inflation is normal. Around 2% per year is manageable. But when it spikes, savings erode and wages struggle to keep up. That's when governments step in by raising interest rates. Higher rates make borrowing more expensive, slowing spending and cooling the economy. Less buying, less pressure on prices. Recessions. A recession is when the economy shrinks for at least 6 months. One moment life feels stable, the next, layoffs, falling markets, and uncertainty everywhere. Recessions happen for many reasons: high interest rates, global crises, pandemics, wars, or simply the economy cycling as it always has. Think of the economy like a party. At first, it's booming, music loud, everyone spending. Then reality hits. The lights flicker, someone checks their bank account. Suddenly, the playlist switches to sad corporate lo-fi. Recessions hurt, but they reset the system. Governments respond by cutting rates, injecting stimulus, or waiting for confidence to return. Eventually, spending resumes. Growth restarts, but not without scars. Credit scores. Your credit score is a 3-digit judgment of your financial behavior. It doesn't measure wealth, it measures trust. Lenders want to know one thing: if we give you money, will we get it back? Scores range from 300 to 850. Below 580, red flag. Above 750, financially trustworthy. Most people land somewhere in the middle. Your score depends on 5 things. Do you pay on time? How much credit are you using? How long have you had accounts? Do you use different types of credit? Are you applying too often? Miss payments and your score drops. Pay consistently and it recovers. Think of your credit score like a pet. Ignore it and it wrecks your life. Care for it and it helps you buy a home. It's not about being good with money, it's about looking reliable. Taxes. Let's start with taxes. Picture this. You've just survived a brutal month flipping burgers at a fast food joint. You're exhausted, lying in bed when an email hits your phone. Payday. It says you earned $2,000. You check your bank account. Only $1,456 landed. You scroll through the pay stub. Federal tax, state tax, Social Security, Medicare. A neat little list explaining how a chunk of your labor vanished before you ever touched it. This is the modern ritual, handing over part of your paycheck to invisible systems and being told it's for your own good. And to be fair, it kind of is. Taxes are the price of living in a functioning society. You pay in and the government builds roads, runs schools, inspects restaurants so you don't get food poisoning, and occasionally funds billion-dollar projects halfway across the planet. But not all taxes hit the same way. Income tax takes a cut when you earn money. Sales tax takes a cut when you spend it. Capital gains tax takes a cut when your investments grow while you're asleep. Then there are payroll taxes. Almost everyone pays them. Social Security is basically forced retirement savings. You're required to contribute now, so future you gets a monthly check later. Medicare is a health insurance tax that supports seniors and people with serious medical needs. And then comes the fun part, filing taxes. The government already knows what you owe, but instead of telling you, it makes you guess. If you guess correctly, great. If not, penalties, stress, and paperwork hell. Some people pay quarterly, some yearly, and some don't pay at all and end up as cautionary tales. Taxes are annoying, no doubt, but here's the trade-off. Countries with higher taxes often deliver better infrastructure, healthcare, and overall quality of life. You're not just losing money, you're buying stability. Investing. Inflation steals quietly. Investing fights back. Investing is when your money stops sitting idle and starts working. Instead of trading time for income, you trade capital for growth. There's risk, but there are options. Stocks give you ownership in companies. Bonds let you lend money for interest. Funds spread risk across many assets. Real estate generates income from property. Most wealth isn't built overnight. It's built by starting early, diversifying, and letting compound growth do the heavy lifting. The real risk isn't market swings. It's never investing at all. Value. Value is subjective, and that matters. A rock is just a rock until it's gold. Gold isn't better because it's special. It's valuable because people believe it is. Money flows towards value. Create something people want badly enough, and they'll pay for it. That's why innovators, professionals, and brands earn so much. Luxury brands sell perception as much as product. Same function, higher value because people say so. If you understand how value works, you can create wealth. Time. Time is the ultimate asset. Everyone starts with some. No one gets unlimited. Most people trade hours for money. High earners learn to multiply the value of their time with skills, leverage, and systems. But nowhere is time more powerful than investing. Wealth isn't built in days, it's built in decades. Small, consistent investments compound quietly, then suddenly. That's how ordinary people retire wealthy. They didn't hack the system.